is to advise and to educate my clients on how to help them achieve their financial goals. Sorry, just get rid of that pop-up. So financial goals can range from when to retire, helping people to buy their first house, helping people eliminate debt, or simply creating strategies on how to save and build wealth. So I'm pleased to talk to you today about building wealth. This is one of my favorite conversation topics. So let's get started. Oh, I think I skipped two. There we go. So today we're going to talk about a few concepts. We're going to talk about how to save. We'll talk about some saving options. We'll talk about the types of investments and asset classes. And finally, some thoughts on income from investments. And once we're done this little presentation, of course, I'll be happy to answer any questions that you may have. Okay. So first step in wealth accumulation really starts with savings. It's easy and, of course, necessary to focus on paying bills, but the old adage, pay yourself first, comes to mind. You could save with lump sum amounts like an inheritance, but the most practical way to save is on a monthly basis. For some of my clients, building a budget is necessary. Budgeting doesn't sound like fun, and most times it isn't, but it's a simple way of determining what savings you have and or could have. The budgets I've helped my clients create include estimating monthly expenses at the beginning of the month, and then comparing those estimates with actuals at the end of the month. Once you do this a few times, you'll start to see where you could potentially be saving. Taking advantage of any employer-funded savings options is also a great way to save. And for most people, that should absolutely be maximized when possible. And we'll talk a little bit more about that in a second. Okay. So after building a budget and finding some potential for savings, some of my clients worry about the dollar value not being high enough, but they often forget about the power of compounding. So take a look at this example. In scenario one, John has $10,000 that he invests. He doesn't make any more contributions, and if he averages a 5% rate of return over 20 years, he'll have turned that $10,000 into $27,130. So not bad. But in scenario two, John doesn't have a $10,000 initial investment. He just has $250. But every single month, he makes another $250 contribution for the same 20 years. If he achieves and averages that 5%, that same 5% rate of return, he will have $103,872 after that same 20 years. So pretty powerful example. And you can see with this example why Warren Buffett, one of the wealthiest people in the world, speaks so highly of the power of compounding. It really is a simple yet amazing concept that means you do not have to start with a large sum of money to build wealth. A regular contribution is easy to start and then maintain. You can set up contributions on a regular basis and simply forget it. You can determine the amount to be saved, the frequency, and even the investment type, making the process very simple. So if we now have you convinced that you need to save and saving is relatively easy, then the next question I think should be, well, where does it go? So making RRSP contributions, making contributions to an RRSP provides an immediate tax benefit that will reduce your taxes payable. So in my world, I consider the RRSP a perfect vehicle for building another source of income for when you retire. The best time to contribute to your RRSP is when your income is higher than it will be when you withdraw. The taxable benefit you get from making a contribution and the taxes owed on a withdrawal are based on your marginal tax rate, which is exactly how much you pay, how much taxes you pay to the province and to the federal government combined. So let's say you are working and earning a good income and your marginal tax rate is 40%. If you make an RRSP contribution, you get the equivalent of a 40% taxable benefit in the year you made that contribution or apply the contribution. If you then retire and your marginal tax rate drops to 25% because your income level has dropped, when you make an RRSP withdrawal, the taxes owed will be 25%. For most people, that's a pretty probable scenario that you will earn less in retirement than while you worked. The tax-free savings account, or the TFSA, is an extremely valuable account, given that the capital contributed, so the money you put in, and the income earned is never taxed. The TFSA sounds like a savings account, but it can hold stocks, bonds, mutual funds, just like an RRSP. I normally recommend the TFSA as a great place to build an emergency fund, given the flexibility inherent in the account. The TFSA started in 2009, and if you've lived in Canada since then, and you were over the age of majority in 2009, you have accumulated $75,500 of contribution room. So every year you gain more contribution room, and in 2021, you gained another $6,000 of room. If you remove money from the TFSA in 1 year, you can put that same amount back in the following year, plus the new contribution room. So you never lose that original contribution room. Pretty valuable. There are limits on the amount of money you can contribute to an RRSP and TFSA, but no such restriction on a non-registered account. A non-registered account is another investment account, meaning that you can hold stocks, bonds, mutual funds, etc. There is no tax benefit for making a contribution to a non-registered account, but there is a different tax treatment for the gains in this account, which we will discuss a little later. A non-registered account can be joint, whereas an RRSP or a TFSA must be individually owned. This joint nature provides advantages in terms of who claims the taxable benefits when realized, for instance. So as mentioned, each account has different tax treatments, and so an efficient strategy takes advantage of each account to satisfy all of your financial goals. So for instance, let's say you get a 10% rate of return in your TFSA, and a 10% rate of return in your RRSP. Because of the tax treatment, we know that those rates of return are not equal. So in the TFSA, you get a true 10%, but in the RRSP, it's not a real 10% because of the taxes you eventually have to pay on that growth. So the question I always ask is, why would you take the same amount of risk in each account to potentially get less in one? So building wealth is easier when you are efficient in how you invest by knowing and taking advantage of the differences between the different types of accounts. Hopefully that makes sense. Excuse me. So the Government of Canada provides grant money to help people save for their retirement or pay for education. The RDSP, or the Registered Disability Savings Plan, provides people with disabilities grant money based on matching a certain percentage of contributions and is typically used as a retirement fund. For lower income individuals with an RDSP, there's also the potential of receiving government bonds without having to make any contribution whatsoever. The RESP, or the Registered Education Savings Plan, is an ideal account to save for your children's or grandchildren's post-secondary education. By making contributions, you can receive a matching grant up to 20%. For lower income families, the bond is also a possibility. There are a ton of rules around these two types of accounts, and I suggest you speak with a professional on how best to utilize them. But it's important to know that they exist for sure. A workplace pension is another valuable savings vehicle. There are essentially two types in Canada, the defined benefit plan and the defined contribution plan. In a defined benefit plan, the future value of your pension is known, and if the performance of the plan falls below expectations, the employer must make up the difference. So for instance, let's say you know that your pension will pay you $50,000 a year when you retire. While you are working and making contributions, your pension is invested. If when you retire, the pension has not performed well and there's not enough money to pay you that $50,000, the liability rests on your employer to ensure you get your full pension per year. In a defined contribution plan, the future value is not known, and therefore the potential risk falls on the employee. So if the pension plan does not perform well and your pension will fall below your $50,000 expectation, then you have no recourse as your employer is not responsible for making up the difference. So pretty important to understand the difference between the two types of pensions. Most companies, most governments are moving towards a defined contribution pension plan simply because there's less onus on them for making sure that the value is there. Okay. Some companies will offer a deferred profit sharing plan and or an employee savings plan. Both are extremely valuable, and in most cases, participation and contribution should be maximized, especially if your employer is offering a matching contribution. It's just like free money. So who doesn't like free money? These accounts are typically considered another form of retirement savings. If you leave your employer, there are rules on what you can do with these accounts, but the benefits of making contributions that may be matched are outweighed by the complications that come with utilizing them. So very important to understand the options that you may have. Okay, so now that you know you should be saving and where some of those savings should go, let's talk about the different investment types. A savings account is a bank account in which you can put your cash and gain a small amount of interest. Most of us have had or will have a savings account at some point in our lives, for sure. A GIC is a guaranteed investment certificate in which you lock away your investment for a certain period of time, like 1 year or 5 years, and you get paid interest to do so. So if you put $1,000 in a 1-year GIC, for instance, the value of that money will never go below $1,000. And in 1 year, it will mature, meaning that the $1,000 plus the interest you gained over that year is now available to you for you to use or to reinvest. A bond is a form of debt you can buy. So for instance, a company or a government will issue a bond that essentially says, you pay us, let's say $950 today, and in 1 year, we'll pay you back $1,000. And that's essentially how bonds work. But the timing and the structure of a bond can vary greatly. And this is an immense simplification for sure of what a bond is. But in fact, the bond market in the US, for instance, is twice the size of the stock market. So it's exceptionally important to understand what a bond is and how to utilize those, of course. So let's talk about stocks. A stock is a form of ownership. If you buy TD stock, for instance, you are a shareholder of TD. And when TD makes a profit, the value of their stock may increase, and they typically pay their shareholders a dividend. So a dividend is a share in the profits of the company. Now, not all stocks can receive dividends, and not all companies, when profitable, pay dividends, but you can receive the dividend in the form of cash, or you can have that dividend reinvested in the stock from which it's derived, so that the dividend buys more of the same stock. Again, pretty simple explanation. A mutual fund is a combination of stocks and bonds, but it can also be all stocks or all bonds. It is essentially a great way of providing a ton of diversification. So instead of owning a few individual stocks, you could own hundreds of them in a mutual fund and have professional money managers make day-to-day decisions in that fund on your behalf. They would decide, for instance, do we buy more of Microsoft today? Do we sell Google? All that kind of stuff. And an ETF is a lot like a mutual fund, but typically the mix in an ETF is based on an underlying index, like the Toronto Stock Exchange or some specific parameter. The costs tend to be much lower than a mutual fund in an ETF because there generally isn't the same management oversight. So all of these investment types have different tax implications, and those implications may depend on the type of account in which they're held. So for instance, if you are paid a stock dividend for a stock you hold in your RRSP, that dividend will lose its structure, given that any withdrawal from an RRSP is taxed as interest income. It's just like earning a salary, for instance. Okay, so a couple of important things to understand about investing. Really, when I speak with my clients, we talk a lot about liquidity and risk. If your investments are liquid, it means that you have quick access to them, like cash in a savings account. If they are illiquid, it means that they are locked in and access is limited, like a 5-year GIC that we talked about earlier. Risk is an extremely important concept, and in my practice, I spend a ton of time ensuring that my clients' investments accurately match their risk tolerance. So there are a few types of risk to be aware of. Inflation risk is the risk of having your rate of return being lower than the inflation rate. So for instance, a 1-year GIC that pays 0.5% will not maintain your purchasing power if the inflation rate is 2.5%. Investment risk is the risk associated with the investments themselves. So for instance, stocks are generally riskier than bonds. Liquidity risk is not having access to your funds when you need it. Market risk is the risk imposed by the overall market or markets and potential for disruption. Okay. So building an efficient portfolio, as I mentioned earlier, means understanding the tax implications that come from growing your investments. So once you know how you will be taxed, you can allocate your savings in different ways. You can take more or less risk in certain accounts and make plans for when things change in your life, like moving into retirement. So interest income, dividend income, and capital gains are important to understand. For instance, in Canada, our capital gains have a 50% inclusion rate currently, meaning that when you realize a capital gain, you are taxed on 50% of that gain. You then pay that taxable gain at your marginal tax rate. So let's say you invest $10,000 in a non-registered account and you hold a mutual fund. After 1 year, that mutual fund has grown and your investment is now worth $15,000. You decide to sell that mutual fund and withdraw the cash to, I don't know, buy a boat, for instance, maybe. Boats are not great investments, but still. Let's say you take out that $15,000 and decide you're going to buy something. So you will have realized the capital gain of $5,000 and have a taxable gain of $2,500, and therefore pay tax on that $2,500 at your marginal tax rate. So knowing the implications, understanding the taxable implications can really help you make some informed decisions on how to use and how to grow your wealth. Having a good, solid partner like an accountant is always very important when it comes to these kinds of conversations, as I'm sure that small little example can illustrate. Okay, so you have a lot of choices when it comes to how you invest. You can choose the self-directed model, which is essentially a do-it-yourself plan where you make the day-to-day decisions on where your money is invested, and it's generally associated with lower fees. There are many low fee, or now there's a bunch of no fee options in terms of investing when you're doing it on your own these days. I'm thinking like Wealthsimple and Fidelity, and some of these different places now are charging no fees for any transactions. They're just happy to have your money on their system. So it's important to make sure that you understand your full option. So for the advisor model, for instance, is working with someone like me. I spend my time advising and educating my clients so that they can achieve their financial goals in the most efficient manner possible. I discover my clients' goals and work backwards by helping them decide on saving strategies, investment mixes, tax implications, etc. And the vast majority of my clients don't have the time to focus on their investments the way that I do, or they don't have the expertise and they look for someone else to help them make those decisions. So both models have pros and cons. And I always say that, educating yourself on the differences is crucial to making sure that your investment experience is what you want and as rewarding as you want. Okay. So there's always some important concepts to consider when I have a conversation with a prospective client. There's a lot of different things that we talk about, but there's always some things that I want them to know and I want them to understand and appreciate, whether they end up working with me or not. So I always start by talking about goals. So I think it's important to set a goal and to be very specific with that goal. So instead of saying something like, well, I want to retire early, I would prefer my clients to say something like, well, I want to be able to retire at age 55 and be able to spend $50,000 a year after tax for the rest of my life. That's a very different goal. It's a very specific goal that allows us to build, strategies and parameters around how we're going to achieve that. I think it's also important to understand your time horizon. So when you're talking about goals, is that a goal, for instance, that, I'm going to have to replace my roof next year, so I'm going to need some money for that? That's a very different time horizon for saying I'm going to retire in 20 years, or wanting to know how much I need to save to pay for my daughter's university when she goes to UNB in 15 years. It's important to understand the parameters and the implications that time has on those goals as well. Of course, knowing your risk tolerance is crucial. I can ask a client if they will be comfortable with a 10% loss in any given year, and most clients will say yes. When I say that on a $250,000 portfolio, that's a $25,000 loss in any given year, some will change their answer. So it's easy to get caught up in, percentages, and my whole industry, it's all we talk about are percentages. My focus is really on bringing it down to a specific dollar conversation, because when you hear 10%, maybe it doesn't really mean a lot. But when I say that's a potential loss of $25,000, usually I get a different reaction. So important to understand the implications of that kind of risk tolerance and risk conversation. I also think it's awfully important to set priorities. You can list your savings goals and rank them in terms of priority. It may not be possible to do them all at once. And so I think being realistic is important. Knowing that, you have a certain amount of debt that you want to address first before you start saving, those kinds of things are just going to be beneficial further down the road. Increasing your investment knowledge is always encouraged. I always think that you need to find good, solid, reliable sources of information and take everything you hear with a grain of salt. So I say that because a lot of the information we get these days, whether it's Facebook or the news or whatever that is, sometimes comes with an agenda. And I always think it's important to understand that your neighbor's situation may be very different than yours. So I think you need to seek out unbiased sources of information. They're hard to find, but we can talk about that in the Q&A if you wish. And then I always think speaking with an advisor. Some of the wealthiest people that I know have surrounded themselves with a good, solid team of experts. So they have access to a good lawyer, an accountant that provides strong advice, and of course a strong financial planner. The days of buying and selling stocks and bonds and all that kind of stuff, it's still here. But my profession has evolved to include financial planning, retirement advice, insurance advice, all those kinds of different things to make sure that you are able to make good, solid decisions. Because really, at the end of the day, that's who I am, and that's what a professional should be, is someone that's providing advice so that you're making informed decisions. So that's really what I wanted to talk about. That's sort of the formal part of this presentation. I would just want to end by saying that I think it's important to evaluate your personal situation and ask yourself about your goals. Spend time defining those goals, knowing that they may evolve over time. I think seeking advice from an advisor like me comes with no cost or obligation. It's always a good place to start. But I think it's more of, okay, so what is it that I'm trying to achieve? Having conversations with people that are investing currently or saving currently or building wealth currently, that always helps. But again, I say take all that with a grain of salt. Seeking unbiased advice, I think, is exceptionally valuable. So thanks again for the opportunity. I certainly appreciate that. I think that this association is absolutely needed in our province, and I'm just excited to be asked to be a small part of it. So thank you, Darren, of course, for the opportunity. And And I'm happy to answer any questions that anyone may have.
Hi, thank you so much, Darren. That was a great presentation, very informative. If you have any questions, please just use the chat feature, which is available in this software, and Darren will happily rather answer any questions. And it's the forum's open to you. We look forward to hearing from you.
Well, I have a question, Darren, that I usually get asked.
Sure.
Okay. So I think that there's a lot of conversation these days about Bitcoin, cryptocurrencies, those kinds of things. And I was on where was that? I was on Twitter the other day, and there was a list of values of money. So if you had invested $1,000 in the various different cryptocurrencies at the beginning of this year, what the value would be right now. One of them said if you put $1,000 in at the beginning of this year, it would be worth $780 million today. And so I thought, well, why didn't I do that? No, I just kidding. I thought, well, it's kind of misleading. And there's a lot of conversation about the money that can be made in cryptocurrencies. And so I just wanted to say, I can appreciate the strategy behind what they are. I think the technology behind them is revolutionary. The blockchain technology and how things are decentralized, I really understand that and appreciate that for what it is. I think that the hype that comes with a lot of these things is really just that we have to be mindful as investors to think not only, well, how do we grow our money, but how do we, once we get to that point, how do we use it? And that to me is part of the biggest issue with cryptocurrencies is that, so if you were that one person that has $780 million in this cryptocurrency, the next question is, so what can you do with it? And the answer right now is pretty much nothing. So you can't really use it as currency. Some places that's going to change. Last year, I think it was, where Tesla announced that you can buy a car with Bitcoin. Like, that's pretty revolutionary. Mm-hmm. So once we start to see more of that happening, then the cryptocurrencies will actually have some real world value. Right now, in the same article that talked about having $780 million in this cryptocurrency, it suggested that one of the ways of spending it was by buying gift cards. And you could buy these $10 Microsoft Live gift cards. And I thought, boy, that's a lot of gift cards. So I just think that it's an interesting technology. I think right now it's a lot of gambling. There's no real underlying value to it. And I would much rather, none of my clients hold any cryptocurrencies. And I would much rather see someone invest in something solid. Like TD, RBC, a good, strong company involved in oligopoly, where they have not only increased their profits consistently for the last 20 years, but have also increased the dividend payout for the last 20 years. To me, that's more of a solid investment plan as opposed to gambling some of your money away.
Right. And I had a quick question too. That might be for people who are watching this now. And this will be loaded up to our website too for anybody that's online. Great. And if they've missed it, all of these information seminar series are on our website at www.nbmeded.ca. And if you go down the left column, you'll see information seminars, and they'll be posted. This is our third one this year. We'll work on 3
Great.
new ones for 2022. So give us a day or so and it will be loaded up there for you to watch. But what I'm curious about, now I have both, but I'm older, so it's a little different in my case, but I think about some of our younger audience that may be watching this or watching this later, and especially to anybody who's just getting into investing, what's the best, I guess, what would be the best tools to use to start off with? Is it an RRSP or is it a TFSA or is it a mix of both?
Yeah, that's an excellent question, Darren, and I get that an awful lot. In full disclosure, the average age of my client is probably around 63, 64. But I speak with them a lot because they're having conversations with their children, for instance, that are just starting to invest. And so we have these conversations. And in my mind, I think that when you're young, my kids are 26 and 24. And I think that putting money into a tax-free savings account now is the most prudent thing to do because it just provides you with the most flexibility. So why that's important is because if you were to invest in an RRSP right now, as I mentioned earlier in the presentation, you get a taxable benefit for making that contribution. So if your income level right now, let's say your tax bracket is around 20%, because you're just getting started in your career and you're just starting to, to make some good money, that kind of stuff. If you make an RSP contribution, you're getting a 20% benefit for doing that. If you were to take that same money, put that in your tax-free savings account and have it grow in your tax-free savings account where it's growing tax-free, then in another 5 years or so, when your income is higher, then you can take the money from the tax-free savings account and make the RSP contribution then. So what you're doing is that you're taking some cash now, some after-tax cash, you're putting it into an account with a ton of flexibility, the tax-free savings account, and then it allows you to utilize that later on. So you can use it for a vacation, you could use it for, I don't know, a new car, but you can also use it to make your RSP contributions when you will get a bigger bang for your buck. So for anyone that's younger, anyone that's just starting out, my focus is always on the tax-free savings account.
Great. Well, thank you very much, Darren. I don't think we have any more questions. A couple of people have posted just saying, thank you very much for your presentation. It was very informative. And as I indicated, we'll be doing this again in the new year. We don't have the topics yet, but we will certainly be posting it through social media, through our email list as well. And this will go on our website. I'll send an email to those that registered for this to let them know where it can be found on the foundation website. And Darren Dearing, thank you so much for your presentation. And thank you so much to TD Financial Group for, again, providing 2 remarkable scholarships for 4 years. That will really help the next generation of medical students become our future doctors in New Brunswick. It means a great deal to us.
Well, thank you, Darren and Natalie. We're big fans of everything you're doing, and it's so needed here in New Brunswick. It's exciting to have someone champion the cause as well as you do. So we're happy to participate in any way we can.
Well, thank you, and everybody have a lovely evening. And again, thank you very much, Darren. We appreciated your presentation.
Thanks, Darren. All the best.
Bye now.